Stocks experienced a noticeable decline yesterday as investors reacted to the release of the monthly Producer Price Index report, which measures the rate of inflation as experienced by businesses, often referred to as wholesale inflation. The report for July revealed that inflation in the business sector rose by 0.9%, which was considerably higher than the forecasted increase of 0.2%. This unexpected rise in wholesale prices created a cautious mood in the market, resulting in a subdued and muted finish for major stock indexes across the board. Stephen Brown, an economist at Capital Economics, explained in a client note that some of the increase can be attributed to higher costs in portfolio management. While these cost pressures exist, they are not expected to alarm the Federal Open Market Committee, which is the branch of the Federal Reserve responsible for setting monetary policy and determining interest rates. Following the release of this data, the probability of the Federal Reserve implementing an interest rate cut of 1/4 of a percentage point at its upcoming meeting next month fell from 100% to 95%, according to the data from the CME Group, a derivatives exchange that tracks interest rate futures. Looking ahead, Federal Reserve Chair Jerome Powell is scheduled to address economic conditions and outline his perspective on the United States economy at the Jackson Hole Economic Symposium, an annual gathering of central bankers, policymakers, and economists, where critical insights into future monetary policy decisions are often revealed. Turning to the housing market, the average 30-year fixed mortgage rate reached its lowest level since October of 2024 this week, falling slightly from 6.63% to 6.58%. While the decline is relatively minor, it provides a temporary relief for potential homebuyers amid a period of persistently high mortgage rates that have dominated the market for much of the year. The decrease in mortgage rates is closely tied to a slight reduction in bond yields, which themselves were influenced by weaker than expected hiring numbers reported in the July employment report. Michael Frattantoni, chief economist at the Mortgage Bankers Association, explained that short-term dips in mortgage rates create brief windows of opportunity for buyers and refinancers, but such moments are likely to be fleeting and should not be interpreted as the start of a sustained trend. Over the course of this year, mortgage rates have generally hovered just below 7%, which has created a challenging environment for home sales. The combination of higher borrowing costs and elevated listing prices has contributed to homes remaining on the market for longer periods, and fewer buyers qualify for mortgages under these conditions, which has put downward pressure on transaction volumes. This environment has required both buyers and real estate professionals to adjust expectations and approach opportunities strategically. In corporate news, the Trump administration has reportedly been considering a potential acquisition of a stake in Intel, one of the largest semiconductor manufacturers in the United States, as part of a broader effort to advance its planned manufacturing facility in Ohio. Sources cited by Bloomberg suggested that while plans remain fluid and not yet finalized, the United States government may take an ownership interest in the company in order to accelerate the completion of this long-sought facility. The arrangement would align with recent federal initiatives in which the government has become involved in industrial partnerships, including arrangements with Nippon Steel and a deal that allows the United States to receive 15% of revenue from NVIDIA sales of the H20 chip. A potential transaction with Intel would reportedly be contingent upon Lip Bhutan remaining in his role as chief executive officer, which highlights the importance of consistent leadership in strategic partnerships. Meanwhile, Tesla is actively laying the groundwork for the eventual introduction of its robotaxis in New York City, which represents a major step forward for autonomous vehicle technology in one of the most densely populated urban areas in the United States. Tesla recently posted job listings seeking drivers to operate in the city while collecting data for its autonomous vehicle division, offering compensation of up to $33 per hour. This phase represents the initial step in a process that could take several years before fully autonomous ride-hailing services are operational in New York City. However, the company is progressing more rapidly in areas with fewer obstacles, such as in Texas, where Tesla has obtained permits to operate its autonomous ride-hailing service in Austin. This pilot program is currently invitation only, but provides valuable data and operational experience for Tesla's long-term goals of deploying fully autonomous ride-sharing services nationwide. At the same time, Alphabet's autonomous vehicle division, Waymo, is pursuing a more advanced approach in New York City. Waymo has submitted an application to test fully driverless vehicles in the city with a human supervisor on board, a regulatory requirement under current New York state law. Tesla has not yet reached this stage in its testing efforts in New York, meaning Waymo is currently positioned ahead in the race to bring autonomous vehicles to the city streets. There remains a legal obstacle, as state law currently prohibits vehicles from operating entirely without human supervision, but Waymo has indicated its intention to work with lawmakers in Albany to modify the regulations. The widespread adoption of driverless ride-sharing services in New York City could have profound effects on employment, potentially displacing tens of thousands of taxi drivers, as well as numerous drivers working for ride-hailing services such as Uber and Lyft. This development signals a major shift in the transportation landscape, with implications for both workers and the regulatory framework governing autonomous mobility. In sports and entertainment, the LA28 Organizing Committee, responsible for the 2028 Olympic and Paralympic Games in Los Angeles, announced a significant change in venue sponsorship policies with approval from the International Olympic Committee. For the first time, corporate sponsors will be allowed to retain naming rights for venues hosting Olympic events, rather than being required to remove branding entirely. Previously, all venues were subject to a clean venue rule, meaning that stadiums like SoFi Stadium, which will host swimming events, would have temporarily been renamed during the games. Under the new policy, major venues such as Crypto.com Arena and Intuit Dome may maintain their corporate titles, and sponsors including Comcast and Honda have already formalized agreements. In addition, naming rights for up to 19 temporary venues will be available, with preference given to prominent sponsors such as Coca-Cola and Visa, which are among the International Olympic Committee's largest partners. This move is part of LA28's strategy to secure approximately $7 billion in funding for the Games without relying on taxpayer dollars, as United States-hosted Olympics traditionally receive minimal government funding. It is important to note that iconic venues such as the Los Angeles Memorial Coliseum, the Rose Bowl, and Dodger Stadium will continue to use their historical names and will not be included in the new naming rights arrangements, preserving a sense of tradition while enabling additional private funding opportunities. In brief international and corporate updates, Israeli Finance Minister Bezalel Smotrich announced plans to construct 3,000 homes in the E1 area of the West Bank, a move intended to limit the prospects of a Palestinian state, which has been widely criticized as illegal by much of the international community. On the corporate front, Berkshire Hathaway purchased over 5 million shares of United Health last quarter, a stake valued at approximately $1.6 billion, signaling continued confidence in the health insurance sector. In labor news, Air Canada and its union representing 10,500 flight attendants remain at an impasse regarding compensation, with both sides warning that service disruptions will begin tomorrow if an agreement is not reached. In technology updates, Apple has announced the reinstatement of blood oxygen monitoring for newer models of the Apple Watch, following a ban by the International Trade Commission, restoring functionality for health-conscious users. Airbnb has introduced a Reserve Now, Pay Later option, allowing United States users to secure bookings without paying upfront, which may provide increased flexibility for travelers in managing expenses. In automotive news, Cadillac has unveiled its new electric crossover concept vehicle, showcasing the company's ongoing commitment to electric mobility and the development of next-generation automotive technology. Taken together, these developments reflect a complex interplay between inflation data, central bank policies, mortgage trends, government-industry collaboration, technological innovation, and global geopolitical dynamics, all of which are shaping the current financial and business landscape. Investors and market participants must navigate these factors carefully, considering both short-term fluctuations and long-term structural changes that could influence decision-making in equities, real estate, and emerging technologies. The convergence of autonomous vehicle advancements, Olympic funding strategies, and international geopolitical developments illustrates the breadth of factors impacting both domestic and global markets, highlighting the importance of comprehensive analysis and proactive engagement for those looking to capitalize on these evolving trends. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.